Hello everybody, welcome to my YouTube channel. I am Adrian, a graduate student of IPMI International Business School Executive MBA class. In this video, I want to share with you some topics related to the corporate finance course which I learned from IPMI and facilitated by Professor Sembel. Let's check it out. Okay guys, we will start this first video with the two topics. The first is the introduction of corporate finance, and then the second one is the basic concept of the time value of money. We will start with the corporate finance. The corporate finance concept is actually about how corporations make good financial decisions from the point of view of management and investor. Management is the internal of the company, and then the investor is the external of the company. So basically the concept of corporate finance is, the first is, what investment should the corporation make? This is about the investment decisions. Investment decisions, for example, is the decision that company make in order to purchase their assets. Their assets such as the plant, machinery, building, car, and another equipment in order to generate money for that business. And then the second, how should it pay? So the company will purchase those assets using the money, and then this is the question is how they make the financing decision, where is the money comes from, yeah. And then this is the basic concept of corporate finance. And in this slide we will you can see that the cash flow between the firm and the financial market. And then the first is about raising money. How the company raising money. The company is raising money by sell their financial asset to the financial market. For example, the company issued the bond for the short-term debt or long-term debt, and then it can also issue the stock, and then sell it to the market, so the investor is interesting to buy. Therefore, the company will get the money, will get the cash that comes from the financial market, and then the money will be used by the company to purchase the assets. And then the company will have the current assets and fixed assets. Those assets will be used in the business to generate money and then generate more cash flow, generate more cash flow. And then as you can see in this flow, the money eventually will come back to the investor or the financial market, which buy the financial assets for the company. The money is also used to pay the government as the tax. And then if they have more money, it will reinvesting, and then the money will retain to purchase more assets, Therefore, the company will have more and more assets, and then those assets will generate more and more money. And then this is the basic of the corporate finance, from raising the money from the financial market, and then to spending money to purchase the assets. This is normally what the financial manager job. And then we will discuss about the goal of the firm, So actually, what is the objective of the firm is established there. The first is actually to maximize profit of the company for the long-term period. It means the long-term period, normally the company didn't want, a good company didn't want to just profit in the short-term period. They always think about the future. So a company prefer to have normal and standard profit, but consistent in the long term and in the future, rather than big profit just in the short term. This is normally what the goal of the firm. Yeah? And then the second is to maximize the shareholders' wealth. This is by increasing the market value and the current price of its shares. Yeah? And as you can see, there are the four cornerstones of the corporate finance. The first one is the core of value principles. So actually the core of value principle is the value which is driven by returns of capital and growth and cash flow. Yeah? And then this is the combination of growth, return of invested capital, and healthy cash flow that drives the value creation. This is four cornerstone is actually all about the value creation that company should have. Yeah? The second is the conservation of value principle. These activities without changing the growth or just moving the cash from right pocket to the left pocket is not the activity which creates the value. Yeah. So the value is created when companies generate growth and return of capital is higher, yeah, than the weighted average of cost of capital, or normally the interest of the bank, and eventually they will generate the higher cash flow. And then the next is the expectations treadmill principle. The company's overall performance or expectation shareholder and fundamental performance, normally the shareholder will have the higher expectation of the company. This must be answered by the management to make the better performance of the company. They must keep up the performance of the company. But the management is also need to consider and then manage the balance between the shareholders' expectation and then the internal company's fundamental. So therefore, it will create the healthy balance. Yeah. And then the last about the value creation is actually based owner principle. No matter how much the resources that the company had, it is always determined by the management who run the company. The illustration of this concept is actually in the golf stick. Yeah. If you have the very expensive golf stick, very good golf stick, but you cannot play golf, the golf stick is useless. Yeah. It is the same than the resource of the company. How big the resources of the company, if the management is not good enough to run the resources, so the company will not go anywhere. It is useless. Yeah. Therefore, the best owner principle is depend on the management and then the stakeholder of the company. This four cornerstone will actually create a value creation for the company. And then the next is, yeah, the value creation is always interesting, yeah, because it's not only talk about the number, but it talks about the story and the people behind the corporation. This is equal, or this is the most important, I think, about the concept of the value creation. In this slide you can see, this is the actually all the stakeholder normally involved in the company, which is the director, and then commissioner, the management, creditor, the shareholder, and then they will they will manage the asset, debt, and equity. And then what determine actually will result the value creation? One of the most important things is the good corporate governance, by the management, which is the transparency, accountability, responsibility, independency, and fairness. This is the good corporate governance, which will result in value creation. Okay, and that's a little of the simple concept of the corporate finance. And then now we will move to the time value of the time value of money is actually a relationship, between the value of money today and the value of money in the future. So and then the basic principle of finance that receiving $1 today is worth more than $1 in the future due to the opportunity cost. What is the opportunity cost? Opportunity cost is actually the benefit that is missed to given up when an investor, individual, or business chooses one alternative over another. Therefore, normally the opportunity cost is the interest of the bank. If you put the money to the bank in 1 year, you get the interest 6%. So that's the opportunity cost. If you don't invest or you don't put in the bank, so you will lose the cost around 6% of your money. Therefore, if we can measure the opportunity cost, we will be able to first translate $1 today and its equivalent to the future, and then translate $1 in the future into the equivalent today. And then the last, about the wealth. For me, wealth related to the financial matter is a condition when we are not necessarily work for money anymore, but we can maximize our assets to generate money in order to fulfill on basic needs and do everything we want to do, or freedom. This is the definition of wealth. Okay, and then see you in the next video. Thank you.